even questions around like clarification. Or there's some acronyms that were thrown out that if you don't understand and you'd like to. Did something just go over your head and you're like, I really, before they get into any moderated discussion or more commentary from the group, anything that you, that springs to mind? Okay, well, I asked. And you're still allowed to put your hand up later if you want. So I want to just have a bit of a powwow up here. We all have, obviously, quite a bit of experience in these markets, and we have quite a bit of scars to prove it. But I think it just makes us more resilient over time. And they are quite nascent. They're nascent markets, and sometimes I have to, because it feels like I've been doing it forever, but in the grand scheme of things, they really have only been around since SOX, NOx, 90s, carbon only 10, 15 years ago. Now we're getting into the fuels space, the clean fuels, LCFS, CFS. Very exciting, still very nascent. But here are some of the things that I get the most, including around the dinner table sometimes. Well, these markets, oversupply, right? Oversupply, that's bad. The market must be broken. Offsets, carbon offsets, they're hot air. The price is so low, it must not be working. The price is so low. So looking at both of you, and I'll tee you up first when you go, but starting with oversupply, because I think also if you look at the tangible things we're experiencing in California and what they're going to be tackling over the next few months and year is there's concern around oversupply of these allowances, right, and what that does. So how do you counter, or at least approach in a very thoughtful, respectful way, the oversupply argument that is raised, and not just in California, but we saw it in Europe and elsewhere?
Sure. So I think, if you look at the oversupply issue, like the first difference between California and Europe is that in Europe you don't have a floor price, and so that's why we saw prices going so low at below €3. So that was the first thing where California was very smart about that, and when they started the system, they thought about what if prices go too low, because regulators tend to think about what if prices go too high, and they tend to over-allocate companies because of that. California thought about what if prices go too low, and then that moved also other markets. So that was, again, a learning experience from the European market where they started removing allowances. But yeah, it might very well be going to the next direction now. What if prices go too high? So yeah, these carbon prices are almost digital somehow. When the market is long, prices go very low. When market is short, it can go very quickly up. So it's there's a lot of learning experience with all this thing happening, and something as well that Lenny mentioned during his presentation is that a long market based on allowances doesn't mean that the market is long that much as well. So a lot of these allowances are being banked for future uses. A lot of those allowances are used for hedging. So yeah, a market long X amount doesn't mean it's actually long X amount, and that's what we're currently seeing in California, where the market is supposedly long, but price is already going up. So there's that going on as well. Yeah.
And Lenny, I mean, you could also share some deep thoughts on the oversupply argument that comes up a lot, but also I think it's really important for everybody to appreciate offsets, and they are unique. Business loves them. Business, the more, the better for offsets, but also offsets get attacked sometimes as well as, oh, offsets hot air, or offsets, you're allowing polluters to pollute even more and not, address the internal abatement options.
Sure. So just to define what offsets are for the audience, offsets are project-based carbon emission reductions, unlike allowances, which are government-issued permits, effectively. So in California and Quebec's case, they have a very narrow definition of project types that do allow for these project-based offsets to be created, and then on a limited basis to be used by the end users at the end of each year or each compliance period. They have to hand in these certificates. The benefit of projects and offset projects is that it's a form of creating additional supply for business, as Katie said. So more supply is always helpful because that should help with price containment. Another benefit of offset projects is you bring in other communities and other projects that are not within the capped sector. So for example, dairy farms, landfills, not in California's case for landfills, but dairy farms, yes, for landfills. Coal mines, you can capture coal mine methane, which California does allow. And so the benefit is you're being more inclusive in terms of who can benefit from an environmental and also from a financial perspective. The downside to offsets is that you need to ensure the integrity of the monitoring, reporting, and verification, which in North America is to date not a problem. In the developing world can be a problem. And then politics, the politics of offsets is a big one. So in California, you have what's known as the environmental justice community, and the environmental justice community hate offsets. Why? Because from their perspective, they want every ton of carbon emissions to be reduced at the power plant level. Why? Because many members of that community live within close proximity to these power plants and have negative health consequences as a result of that. Not because of the carbon emissions, but because of the local particulates associated with the power plants. So for them, their argument is, why are you buying offsets in a dairy farm in Iowa when you should be reducing your pollution next to where I live with my kids? And we've seen that, testimony personally and often. And so it becomes very political very quickly. And then the other side of the political equation becomes, well, if you are the cynic and you think, well, if I'm a cynical legislative person in California and I decide to get rid of offsets, well, what's that going to do? That's going to probably bring the price of allowances up, which means I get more auction revenue to spend on my project. So there's a lot of political sort of movement within offsets, but it is a relatively small part of the marketplace in California becoming smaller. So yeah, I think offsets is a hard one, but at the end of the day, I think from an environmental perspective, if offsets clearly do reduce emissions, they're a benefit, but ultimately, the political policymakers will decide what their view is.
I thank you, and I think that is really important. As you mentioned, when you look at these cap and trade systems, right, you have, depends, but certainly in the California context, big power, big industry, transportation. So you have all of these emissions that are already under a cap, right? So they're already participating in the market, they know, but having this potential offset credits and this offset revenue to these entities that are not under these cap systems, agriculture, forestry, waste. And that's pretty much, we're seeing that consistent pretty much across the board and just growing more towards that trend. So agriculture, forestry, waste. These are kind of that parts of the economy emissions pie that are increasingly open to realizing offset credit creation and meaning revenue generation. Also, in the world of politics, it is really important to have farmers and foresters and all these other players buy in to ensure the durability of the program over time. So I was hoping we talk about the RPS and the low carbon fuel standards, so renewable portfolio standards, the low carbon fuel standards, CFS. I think it's really also critical to understand the interplay with these different measures. Some in California say they call them complementary measures to the cap and trade system, right? But in other circles, like business or my European friends, they call them overlapping mechanisms, duplicative mechanisms. So do you want to share any thoughts just around the interaction or interplay and why it's so important for anybody who is involved or wants to be involved in this space to appreciate?
Sure, yeah. So I think cap and trade has been a very good mechanism to reduce emissions from the power sector because the price was high enough, but it hasn't been so good at reducing emissions from the transportation sector. And so that's something that the regulator realized, and that's why they started introducing these new systems, such as the low carbon fuel standard. And what you see there is that while the price of allowances in California is around $17, actually in this low carbon fuel standard, the price per ton of carbon is around $200 or $180. So you're adding this system on top with a higher price, which is incentivizing emission reductions in this specific sector. and that also has an impact in the cap and trade. So they are overlapping somehow, but they have different, also different type of targets, like different targets. One system looks at the ton of carbon, the other system, actually the LCFS, looks at the emission intensity of fuels. So these are like different type of targeting emission reductions, either by looking at the actual emission, ton of CO2, or the emission intensity. So, yeah.
What I would say about that from an investor standpoint is we view that as optionality, which we love. Meaning, if there's a dairy project that has access to a natural gas pipeline, and in a state where there's a renewable portfolio standard, i.e. paying a premium for electricity, and if it's in a state that either has a low carbon fuel standard or has the ability to get that gas to a low carbon fuel standard state, you're just going to go to where the most attractive deal is. So we very much like having these multiple markets out there because it does provide optionality to us. It provides optionality to these projects. These projects are physical projects, so of course it's not always physically possible to connect to these different markets and programs, but I mean that's happening right now all over the U.S. You know, really weird stuff, but you know, examples are biogas sourced from landfills are being moved to certain markets. Biogas sourced from hog farms are being moved to other markets. So it's very wonkish, but they can result in very real dollars based on the optionality of these different programs.
Are there any questions from the audience? Yes.
How easily can these markets be manipulated by one or two participants, either in accelerating prices to a higher level or collapsing prices to a lower level? How easily can a market be controlled by one or two participants to affect an outcome that's desirable to them, number one? And then as a follow-up, how much is traded in a bilateral basis versus exchange traded? So you can kind of really get an idea for total volumes or flows within the space.
Excellent questions. Thank you. So that was the other, market manipulation. All the myths and the scary words. Market manipulation. Do you want to take the market manipulation and the bilateral?
Sure.
So yeah, on market manipulation, there is some like rules, like in California, for example, where there's a maximum amount of allowances you can hold in your account. So that will limit some of the the holding will limit that some of the speculation, I would say. That being said, on exchanges, so on ICE, if you're buying allowances, there's no limits there. And that means that, there could be some manipulation, but at the end of the day, you should come back to the fundamentals, and fundamentals of the auction. So especially in California, where you have a decent percentage of the allowances being auctioned, if one speculator tries to take the market, the fundamentals should come back in the auction. And that's something, for example, we'll see now, where in California we're seeing prices going up. There's an auction coming up in May, and that should show us a more fundamental price, I would imagine, or see how at least the natural players react to the financial activity, I would say. So like Mm-hmm.
Their absence, do they keep buying through the bankruptcy process, and how did that affect prices in that period?
So PG&E is a good example. So February, there's an auction every quarter in California. In February, they did not participate, and that's the first time I think ever that they did not participate in an auction. The expectation is that they will have to buy more in the coming auctions. That being said, I think they meet maybe around maybe less than between 5 and 10% of the total emissions, I would say. So that amount missing or trying to front run that will like change the market, but it's not enough to really move the market, I would say. But I don't know, what do you think, Lenny? But
I think that's exactly right. I mean, I think it also depends on which market you're talking about. So California, because of their experience in the power crisis years, that shaped a lot of their regulation around physical holding limits, physical auction limits, physical reporting, which again, as Nico pointed out, is different than ICE. I mean, ICE actually do have limits, but they're so high that it's almost irrelevant. But then, to Nico's point as well, you know, if someone's going to try and you know, corner these markets on ICE or something like that, they do that at their own peril because the fundamentals are going to catch up to them one way or the other. In terms of your question, Tom, on the bilateral versus exchange ratios, it varies tremendously by marketplace. So, for example, the California low carbon fuel standard market just last year launched an exchange traded product. So prior to then, by definition, 100% of the deals were bilateral. I don't know the exact numbers off the top of my head, but we would think that in that market right now, the vast majority is still bilateral, although the exchange portion is growing. That particular market, the exchange does not have an option for physical delivery, so that's purely financial. In the California cap and trade market, certainly the majority of the volume transacted on a daily basis is exchange cleared, but then on a quarterly basis, you'll have a significant volume that gets traded. So for example, just to put that into perspective, in the May auction, the cumulative total that will transact in that one day will be approximately 75 million tons. The average daily volume right now on ICE is 2 to 3 million tons. And that number seems to be growing across spreads and options and total volume. The European market, we have an expert here in Alex. Alex, what would your guess be in terms of the ratio between exchange cleared EUAs versus the physical auction and bilateral EUAs?
Bilateral is about 30%.
Bilateral is about 30% in the EUA market, so exchange 70%. And then the much smaller markets, which right now are very, REGI, the Northeast cap and trade market, that is just not a highly traded market at the moment. Having said that, you still will see slightly more volume trade on exchange than bilaterally.
Once again, these have expiration dates? Are they like a regular future strip where you have expiration dates along the way, or is it?
So it depends on the market again. So in the California market, you're purchasing a certificate that has a particular vintage year. So for example, if you were to buy this year a vintage 19 certificate on a futures market for December 2019, and let's say that you took delivery of that in December 2019, you could hold on to that until 2030, because in that market, they do not expire. In other markets, they do expire. So for example, some of the RIN certificates have a 2-year expiry, so it's use it or lose it. Some of the renewable energy credit markets, it's use it or lose it. So again, it really comes down to the individual market. But the implications of that are huge. If you're long something, but you're off on your timing, you're in trouble if you have a certificate that's going to have an end use.
Yeah. And maybe something I wanted to add as well on the something specific about this market as well is that there's no cost of storage to an allowance. You hold it in your account, and essentially, like the curve of allowances should just reflect the cost of money. And if the disconnect between physical and future is too high, then you'll see more and more people, financials, trying to just carry these allowances. You should see this spread reduce eventually. So there's some fundamentals at the end of the day there as well.
When I mentioned earlier, my little airplane that flew into my map around the aviation carbon offsetting program that they're in the throes of really finalizing. They have adopted, this is being the International Civil Aviation Organization, ICAO, only in March, adopted emission unit criteria to help guide which programs could be blessed for airlines to purchase to meet their compliance obligations. Some will be first phase pilot 2020. There's 3 current phases. So anyway, now they're having discussions around vintages, right? Mm-hmm. Vintages, constraints, some kind of restrictions, quantitative constraints, use it or lose it type. So those things are happening right now, and it's again quite a live, very important discussion. There are other hands.
In 2018, I think there was a project between Bill Gates and the EU in a public-private investment vehicle. And I would love to hear your opinion about how that might impact the way that, we have different options in terms of ways of participating in this area, and how that might impact what you're doing, Lenny, particularly, or, if there might be similar follow-on here in the United States as well.
So the question is around public-private partnerships?
In terms of investment vehicle, a fund set up for public-private investment.
Yeah, I mean, so that is definitely something that we would think would grow. I mean, I think there's a lot of policymakers that do like the idea of public-private partnerships, where if you can provide, enough security from the regulatory or the government side, perhaps equity would come in. We certainly would invest in those types of projects. I mean, we're probably even further out on the risk spectrum. We're already, because we are environmental commodity market people, and we're used to these markets, so we're probably more risk tolerant than a traditional private equity investor, certainly than just a plain old vanilla infrastructure group. We would welcome that stuff, but from our perspective, we don't need that stuff. I mean, some of the discussions we're having already revolve entirely around what we believe to be the forward value of environmental commodities across a wide spectrum of applications, where we believe that there's value in a forward stream of these environmental commodities. Perhaps the manufacturer or the producer or the marketer, they either don't see the value, or they are more than willing to say, this is yours in the future in return for some capital now to actually help get us our project going. So effectively it's a way for us to invest at the cost of production, for lack of a better word, in a market that's trading 3 or 4 or 5x the cost of production.
Nico, did you have anything to add? No?
Not on that.
Okay. Let's, again, watch this space as we head to September Climate Summit. And it's a very, very big milestone, and you're going to have a lot of groups that are going to be coming to New York City with some information, plans, blueprints, whatever in hand, to showcase how they're going to help support ratchet up ambition. The beautiful thing about these markets, and really why we can go hand in hand with, say, the Environmental Defense Fund or Conservation International, big business, big environment groups, is because it's results-based, it's about the data, it's about the real greenhouse gas reductions. This is not about, the higher the price, the better necessarily for this space, but real reductions can be achieved. So when you are talking about it through the investor's lens and making commitments around, we are going to, invest in X amount, right, of greenhouse gas reductions over the course of however many years, this space is, it's baked on that, it's built on it, the data and results-based opportunities.
Yeah, maybe something to add on that, actually, from our point of view, or like our clients' point of view. What they are really seeing at the moment is they have some regulatory markets coming to them and asking them to reduce emissions. They also have investors asking them to reduce emissions, because some investor may not want to invest in their company because of the carbon impact or carbon exposure. So and then next to that, you've got the voluntary market that may help these industrials reduce their emissions or offset some of the emissions. So you really see like a virtuous circle with investors, the regulator, and trying to reduce emissions altogether. Yeah.
How are we doing? Time for any final questions or comments from the audience.
Thank you guys for your time.
We had, okay. I think we have to just say, like, the deep thoughts, right? Again, we've been in the space for a while, and genuinely, how do you see things moving ahead over the next couple of years, right?
Yeah.
The opportunity side, has the train left the station on these markets? Briefly.
Yes. I mean, it's as simple as that. I mean, I think that just from the context of the conversations we're having with our investors, the context of what we're seeing in the news, the context of big business from the energy business side to private equity to insurance companies, to me, the train has clearly left the station.
There you go.
And I would say yes as well. But I think one of the trends that you'll be seeing in the coming years is fragmentation, really. So you'll be seeing a lot of different markets with some links, direct links, indirect links, and that also means arbitrage between all these different markets. So that's what I think is something to look at, is try to understand all the rules of all these different systems and look at the arbitrage opportunities in these markets. So.
And for me, it's also just, when I talk about that map and all those colors, and I'm not getting much sleep these days because we're all over the place, but it's moving, and it's moving fast, and they're not questioning climate change or whether or not to do it or the merits of cap and trade and many, many, many of certainly the US biggest trade partners and competitors. So I think that this is just moving ahead. Like I said, keep a watch on September. It's going to be a big month, a milestone as we head to the next UN climate talks in December in Santiago. And if you want to come, let me know. We can help you get a badge for the UN climate talks. Thanks again to Bridge Alternatives and Nico and Lenny. Thank you.
Thank you. Thank you.